Okay, great. It's good to be here. Happy to be here for the 30th annual Winter Finance Conference. For everyone watching on video, I want to say the skiing is epic. We've all sworn not to talk about it when we get back, however. No, this was a fun paper to read and discuss, and also a challenge because I knew Adriana would give a very clear presentation. So I want to kind of just walk through the basic idea in the paper and then offer a couple of thoughts. So what's going on? We've got households who have future income uncertainty. So you might have high income or low income in the future. What are some things you can do to address this uncertainty? You might engage in some real hedging. In other words, we might just choose to engage in less risky activities, try to reduce the risk, that future uncertainty. That's out of this model. So importantly, there's no moral hazard, other actions in the background that people are taking that affect their income uncertainty. So that's exogenous here. If we had a complete set of arrow securities, well, it's obvious what we'd want to do. We'd engage in financial hedging, right? I want to basically take income from the high state and put it into the low state, and that's what we'd want to do. Okay? The friction in the model is the collateral constraint. There's no ability to enforce that when the high state comes, I'm actually going to pay what I said I would pay in that high state. And so we've got to get rid of that aspect, and we're just left with this state contingent saving, which we're going to refer to as insurance. Okay, so that's the only thing we can do is save from the present into different states in the future, but I can't borrow from the future. Okay, so that's the basic constraint that we've got in the model. That's the financial friction. Main results that Adriana talked about: insurance is incomplete and increasing in net worth. Expenditures are precautionary. They're going to increase with risk. Households are going to borrow maximally to purchase durable goods because that's going to give them a source of pledgeable collateral. And we put those two pieces together. We get this sort of balance sheet for intermediaries where they're holding collateralized loans on the one hand and issuing state contingent debt insurance on the other side. And then finally, if we have sort of collateral scarcity, that's going to lower interest rates and insurance provision in the model. So I want to talk about sort of the intuition behind these results. You've seen kind of the formal thing, but let me kind of try to give all the intuition for this. So let's just start with the basic Euler equation, right? Standard Euler equation for saving. And as Adriano mentioned, the precautionary demand you can see comes from the fact that I'm taking expectation of U prime, so I need U prime itself to be convex. That's sort of Leland 68. But of course, we're not in this world where we just have risk-free saving. We've got state S saving possible. We have state S bonds. And so the Euler equation would become, well, I'm going to basically have the state S bond. I got to pay the expected value of that. And that's going to basically mean that we're going to have this, you can think of this Euler equation holding essentially state by state, right? If we had no frictions. Now, of course, we do have a friction. We have the short sales constraint. So what happens with the collateral constraint? It means that we're going to have this hold state by state in those states where I have a positive amount of insurance, where I'm in the interior, or it's going to be strictly less than 1 in the states where I'm constrained. Those are the states I want to borrow from, right? And so what does this mean? If you think about what this means, it means in these states, right, what's going to happen, consumption tomorrow is going to be consumption today plus some growth rate, where the growth rate is going to depend upon the relative rate of impatience versus the interest rate, right? That's our usual consumption smoothing that we get in the standard model, and that's going to apply on all these states, right? We'll have the usual consumption smoothing. And in these states down here, consumption tomorrow is going to be bigger than that, which is not what I want, right? I'd like to basically pull consumption out of those states and have more in the states where I'm smoothing, but I can't do that, right? So in other words, what's happening is in the low states, those are the states where I'm insuring and consumption is going to be smooth. In the high states, I'm going to have this higher consumption than I'd like, but I can't do anything about that, right? I'd like to borrow against that, I can't. Okay, so that's what's going to happen in the model. Okay, so let's see how that plays out and sort of understand these the basic result that I talked about before. And we can think about it. I'll go to a stationary setting a little bit later, but let's think about it in a two-period model, because you can see the intuition in a basic two-period model. So imagine we're in this situation. I've got wealth today. W0 is 25, and this is my income process tomorrow, a 1/3 chance of 5 or 15 or 25. Right? So I know I've got this uncertainty tomorrow. What am I going to do? I'm going to basically contingently save and push some of this wealth, not consume everything for today, but smooth into tomorrow, right? And so what's going to happen is, we sort of drain the water out of this pool and let it fill the other pool until we've sort of smoothed consumption as much as we can, right? And so what's going to happen here is the consumption tomorrow is going to be the max of consumption today and my income, right? So in other words, again, in the low states we've smoothed. That's that consumption smoothing. Here I'm taking the case of beta r equals 1, just so it's obvious. We're going to keep consumption constant. But then there's some states where I'm going to have this windfall. I'd like to borrow against those states I can't. All right, so that's how the model works. Okay, so now let's think about what happens as we change net worth, right? So if as I lower net worth, there's just less, water to fill the pool. I'm going to have a lower level of consumption, less insurance in the future, right? So lower net worth, I'm going to have less insurance. Higher net worth, I'm going to have higher insurance. Up to, at some level, I would be fully insured, right? Okay. Expenditures on insurance increase if income is lower in a first-order stochastic sense, or riskier in a mean-preserving spread sense. So let's think about that. Well, obviously, if I kind of shift my income over so that I have more mass in the low states, the pool gets deeper, and so it doesn't fill as high, right? But the amount of water over here is higher, right? So I'm spending more on insurance. The light blue area is how much I'm financing insurance. I'm spending more. Same thing if I have a mean-preserving spread. So what's the mean-preserving spread going to mean? It's going to mean I'm going to take some of this medium income level here and make it low income or high income, right? That's the mean-preserving spread. And you can see that's going to open a bigger hole here than the amount it offsets over here. And so as I flip that, again, I'm going to be spending more on insurance in that state. So as we do those things, we're going to end up with a bit lower consumption today as we spend more on insurance in the future, as we face more risk, as we have lower income process. Okay, so that, now let's add some durable goods into the picture. What happens when we add durable goods? These durable goods have value in the future. They have value next period. We're going to assume that their future resale value is independent of your income process, and let's just assume it's risk-free, right? That's what it's assumed in the paper. And so that's going to become some forced savings, right? I buy the house, it's valuable tomorrow, that's forced savings. It also then becomes a source of collateral. Now I have something I can use that I can borrow against in the future. And so what are these constrained agents going to do? Remember, because in general, this Euler equation state by state is either equal to 1 or less than 1, and on average it's less than 1, which means that we want to borrow maximally against that collateral, right? We want to borrow as much as we can. And so what's going to happen? So this was the picture I showed you before. Now what I'm going to do is spend some money on a house. I'm going to buy a house. Let's say the house costs 5, and it's going to be worth, say, 5 tomorrow. Let's ignore depreciation. What that's going to mean, I consume a bit less today, but that's going to push this up, and I have this forced savings here. I want to borrow against that as much as I can. So if I can pledge, let's say, 80% of that house value tomorrow, that's going to mean I have to spend less today on the house, all right, because I put a smaller down payment, and I reduce that amount of saving I'm doing tomorrow, which is exactly what I want to do, because that's going to give me more money that I can use to insure the low states as opposed to insuring every state, right? And so this is what it's going to look like if we can pledge 80%. I only have to pay $1 today. This gets down, but I can insure better across the future. Okay? So that's what's going to happen once we add that collateral. Okay, so now we've got those two pieces in the model, and we can think about sort of insurance firms, these insurance intermediaries. What are they doing? They are essentially the household is buying this state contingent debt, so the insurance company is issuing these state contingent debt claims. These are the insurance contracts, and they're holding the mortgages, right? So they lend to provide those mortgages that the households are demanding in order to buy the durable goods in the model. Now, in this case, let's imagine we're in a case where beta R is equal to 1, and let's what's going to happen to clear markets, interest rates adjust. So, for example, in this case, the amount the household is spending on insurance is $5.20, but the mortgage was only $4, we said. So now we don't have supply equaling demand. So what's going to happen is the interest rate's going to fall, right? What happens is the interest rate falls. That allows the agent to borrow more and sort of pay less for the house today because there's a lower interest rate. I'm still pledging the same amount in the future, so I effectively am able to borrow more. It also lowers the rate I get on my state contingent saving, and that's going to reduce that amount of insurance that I have. And in particular, because also with the lower interest rate now, my consumption smoothing of my Euler equation means I want to have a little bit lower consumption next period than I had this period, right? And so the interest rate's going to adjust so that individuals, their consumption smooth path is decreasing. They're also spending less up front until we get to the point where those insurance claims match sort of how much the collateral there is available, which was in this case the $4 in collateral. So that's what's going to happen in equilibrium for pushing down the interest rate if we're in this position initially. Okay, so that's the idea in the model. Okay, let me talk briefly about what happens in the stationary case. This was all in a two-period model, but you can see all the intuition in that model. What happens in the stationary case? In the stationary case, in some sense, consumption smoothing turns into sort of wealth smoothing, right? I want to have, if beta R is equal to 1, then what I'd like is my consumption tomorrow to be the same as consumption today, but since everything's stationary, that means my wealth tomorrow should be the same as my wealth today, right? And so what happens here, if I have wealth W0 today, I'm going to save so that I have that same wealth tomorrow, and then if I end up in those states, my consumption would be, I'll repeat the same game tomorrow, my consumption would be the same as it is today. Of course, again, I might get this positive shock in the really good states, in which case I'll be able to consume a little bit more. Okay. Because if beta R is greater than or equal to 1, what this means is that consumption and wealth never fall, right? I'm maintaining my wealth at a given level, or I might get a positive surprise and it goes up. So what that means is ultimately I'm going to get to full insurance. Once I get a realization of the highest possible state, from then on, I'm just going to keep my wealth at that level forever, and my consumption will be smoothed at the expected value of my income forever after that. Okay? So if beta R is bigger or equal to 1, as soon as I get to the highest state, then I have full insurance from that point onward. Okay. Now what happens when beta R is less than 1? Then optimally, because interest rates are really low, I want to have more consumption today and a bit less consumption in the future. And so we're going to get a picture like this, right? I'm going to target a bit lower level of wealth and a bit lower level of consumption next period. And for that reason, I'm never going to get to the full insurance case. Okay. Even if I were in the high state today, I would take a little bit of risk tomorrow. And so what does that mean? Ultimately, it means, this is just an example, if income were uniform and we had log utility beta R is 0.9, starting from the highest possible income of 100, I'm going to insure my wealth tomorrow so that I have at least 83, but not 100. Which means that if I have a bad shock tomorrow, then I'm going to move down another notch, and then I insure my wealth to a level of 70. Okay, if I get something above that, great, but if I have another bad shock, then I'm down to 60, et cetera, and by 18 shocks, I'm basically down to no insurance. Okay, so that's what's going to happen if we have beta R less than 1 in this case. I'm taking a little bit of risk each period. If I've got too many bad shocks, though, that means I'm going to be in this uninsured state ultimately. Okay, so that's the model. I want to talk, there's one last thing I want to mention, which is sort of related work in terms of where to go from here. So I was thinking, there's a lot of interesting sort of different ways you could go in terms of macro interpretations, et cetera. The challenge, I think, for the paper is there's already a fair amount of work that's very close to it. So let me just mention a couple things quickly. Kruger and Uhlig in 2006 basically look at this case of arrow seekers with short sales when agents can walk away. And kind of have the sort of full partial insurance result. It's all not looking at the collateral channel, but they have that component. Lustig in his dissertation has sort of housing together with the short sales constraints on contingent saving, and has agents borrowing against housing wealth and shows that this can raise risk premia in a macro model, and then kind of does that again with Chan and Lustig, look at if income variability goes up in downturns, that creates higher and countercyclical risk premia. So in terms of a lot of this, at least on the macro side, there's a bunch of stuff that's very close out there that probably should be maybe discussed a little bit more. And so I think where to go from here, it has to be much more deeply on the insurance side in terms of what are some really concrete things we can look for in the data on insurance that this is going to help us explain and so forth. So let me stop there.